Well, I'll pull up the slide in a minute. All right, guys, let me go ahead and jump into today's content. Go ahead and mute everybody up, and then I'll unmute everyone in a minute. Okay, so our trailer today is bullish on the SPY. Again, my concern is that there was no cheerleading from the trade team this morning, saying that the phase one trade deal is going the right direction. However, we do have rumors that the USMCA could potentially be signed this evening. So that's one. Two, we've seen a trend that Trump likes to dish out any negative data or news after the market closes, and they tend to try to boost markets higher in the morning. So very interesting that there were no interviews on Fox Business or CNBC this morning related to the China trade deal. So that definitely makes me wonder why. In terms of our total portfolio, we're pretty much aiming down in most of the portfolio except for our Monday, Wednesday, Friday SPY trade. And again, the general theme is most of the time SPY will trade flat or up and have a high win rate in our portfolio. The catch is when it crashes, it can crash very quickly. We've seen multiple times together as a group, $5, $10, $20 swings to the downside. So while we won't generate a profit with that immediately, the goal is for our put option to kick in. So we have $1 to lose on the SPY, but on the TLT, which we have twice as many shares of, we have room to pick up $3. So once you realize there's twice as many shares, it's almost a 6-to-1 ratio of risk versus reward. So TLT is not falling very fast on us. Let me pull up a chart. Getting a little bit of a bid this morning from the SPY selling off a bit, but in general, our strategy here is to let the SPY put kick in and for the TLT to shoot up. And so depending on what kind of crash we get, the bigger the merrier for our setup going into Thursday. So I am expecting at some point in the afternoon, so after the market's closed, to get some sort of news about the trade front in terms of what I suspect is probable. Most probable is tariffs just simply go up. The stock market's at near highs. We had a blowout jobs report, and the federal funds interest rate decision comes out Wednesday. So I do think there's a high likelihood of Trump saying they're not playing ball. So the tariffs will go up Sunday unless a miracle happens between now and then. And so just last week, we did get one piece of negative news on the trade deal, which did spike the TLT for a day, where he said we'll probably have to do the trade deal after the election. So I think there's a high probability of this happening between now and Friday after the close. So we're still playing the upside of the SPY to capture those profits until we do get a catalyst, because we know that we're loaded up on the TLT, GDX, and emerging markets currently to profit from a down move. Now I do see a new person who just joined in. Welcome, Hexaholic. That's a funny nickname for your user ID, but welcome in. And if you have a microphone, we'd love to hear from you and chat with you a little bit later. So that's our outlook. And again, TLT can be very boring, and then it spikes when there's fear. So that's essentially the setup we're looking for. Same thing over here on GDX. The big picture is that we're moving into QE. And the last time we did QE was at the end of 2008. And you can see how GDX performed for about 2 years after that, really 3 years, as we did QE1, QE2. And then after the economy started to recover and the fear of rate hikes came in, you can see that whole bubble popped really quickly for gold miners. Now, the housing bubble, 2008 in the US, is about 1/10 of the housing bubble that China has now created. So I suspect that this next massive amount of quantitative easing happening could drive GDX much higher than 64. Now, the move will probably take several years to get to the top. And the big question is, what is the Fed going to do once it cuts rates to zero? They could slow it down without a trade war escalating everything. This could be slowed down to perhaps 2 years, and then maybe they stay at that 0% rate for a few more years, like they did in 2008. On the other hand, the trade war escalates, we could find ourselves at the lower bound in 2020. So we'll jump into some more dialogue about that in a minute. The other important charts we're following. LQD is our investment grade corporate bond fund. This means Microsoft can go overseas and borrow money at a negative interest rate, which allows them to essentially get paid to borrow money and buy back their own stock. So as long as LQD is at these all-time high levels, I'm going to be very cautious about betting down on stocks for a considerable amount of time. Now, probably we'll see this one tank first, as this is your high yield corporate bond fund. This has about 7.5% position in those CCC bonds, which have been spiking recently. And we have Don Smith in the webinar. Welcome. I see you got your microphone if you want to say hello and let us know where you're calling in from.
Hello, Sacramento, California.
Nice. Well, welcome to the webinar, Don. If you have any questions, please feel free. Did you get your trade alert email?
I get the email to actually log on to the webinar, but I'm looking for the trade alerts for making the changes on the SLP position.
Okay, great. Yeah, check it out. You should have it probably about 10, 15 minutes ago. So if you don't have it, let us know, okay?
All right, very good then. Thank you.
Sure. Yeah, no worries. Okay, so here's a look at the junk bond ETF. You can see it's not nearly as healthy as LQD. So your Russell 2000 companies have much more expensive costs to borrow. And so I would suspect this will be the first real canary in the coal mine for us in terms of problems in the credit market. So potentially we see HYG tank, then LQD, and then perhaps TLT after it. So we'll keep a close eye on that. But in general, even if we get a trade war escalating, sure, it's going to cause a little sell-off. But what's the big effect? Fed's going to drop rates. They're going to crank up QE. So we're going to want to buy the dip after a short-term sell-off. It's not until the corporations can't gain access to cheap capital that we would be concerned about a long-term bear market in equities. Okay, so let's look at the top charts. Let me pull up today's trade alert.
Don Smith, I just sent you the trade alert just so you have an extra alert.
Thank you so much.
My pleasure, Don.
Yeah, let me know if you have any questions on that, Don. We're here to support you.
All right, I'll do that.
Okay, I'm going to review the trade alert. Okay, so we lost 30 cents a share from Friday through Monday. SPY is down about 22 cents, 20 cents on the underlying. We paid 28 cents to join into the option caller, and we got 18 cents back out. Now we predicted SPY 315 back on October 28th and have been hitting some safe wins on that all the way. We've been quite precautious, worrying that the trade war would escalate. And so we wanted to be positioned to capture a big profit on the TLT and carefully gain profits on the SPY. So we've done a good job on that with a very high win rate. But I do think 315 is about as high as the SPY can go without a trade deal. Open positions are all slightly down, but again, this is that same slow bleed concept. SPY we can hit very consistent wins on. To capture profits on TLT and GDX, you really need to let it have room to run when the pain does hit the markets. And we had another person join in, Jamie Cruz. Welcome to the webinar. If you have any questions, if you have a microphone, we'd love to say hi to you and be able to answer any questions. And I do see your mic's unmuted. How's it going? Nope, back to muted. Okay, well, no worries. If you do have questions, we got the live chat and we've got a lot of folks from our program on the webinar as well. So if you have any questions, please don't be shy to interrupt at any time. So here's our open positions. We're showing a small drawdown in December so far, but again, I think we will see that jump to positive territory overnight. Most likely we're going to get the negative news on the trade deal after the market closes and probably by Friday evening at the latest, potentially today or tomorrow as well. Let's see, here's our breakdown of returns per portfolio. So on the SPY ETF, we've had some good returns, 1% October, 2% November. We're down 0.1% in December so far. Total return on this portfolio is 12%, and that is over a year. We're coming up on our 1-year anniversary this week on Thursday. So emerging markets is up 17.8% in our portfolio in the year. Let's see, we got a live chat. Okay, that's from Dean. This one's had more volatility, but it does represent a much smaller position size in our total portfolio. So you can see that the year-to-date return is adding up all the returns for that year. We did have a little loss in December in this portfolio of 4%. So total return is 12.7. The annual return in 2019 on this portfolio is at 17.8. And what's important is all of these different assets are uncorrelated. So it's not likely that you'll see each position generate a profit at the same time. So we're really trying to capture a profit in one asset and then be patient for the other. Bond portfolio has had really 3 months of drawdown ever since the phase 1 trade deal came out in October. The bond market did sell off and SPY went up, which is essentially our trading strategy. But the problem is the uncertainty that this trade deal would actually be accomplished. Our precious metals portfolio is up 0.8% in December. It had a very hot February, March, April, May. And again, this portfolio has grown in size. Back in December, the Fed said we were having auto rate hikes and reduction of the balance sheet, which is extremely negative for precious metals, cryptocurrencies, etc. But the expectation was that they would have to reverse all those actions of 2018, as 98% of all assets closed 2018 in a loss. So we've been gradually increasing our risk in this portion of the portfolio over the last year, and it has provided the biggest return. After adding capital, which does dilute the total return, this portfolio has a return of 37%. And I do suspect we can remain long on this position for most likely the better part of 2 to 3 years. Looking at our returns against S&P 500, what can you expect? We're going to underperform the SPY ETF all day long when it's traveling higher, but not necessarily lose. It's when the S&P 500 does pull back that our strategy dramatically outperforms. And so you can see in general, we've provided investors with a maximum risk of $1 for every $15 we've earned in a period of 12 months. And there's been quite a bit of volatility and tough times in the last year. So you had a 18% pullback in December, which generated a 1% return overall. And we do have a few new people joining in live. Disappeared. In May, there wasn't really a catalyst, just profit taking after the market had shot straight up. And again, you can see the strategy works. The SPY's put option kicked in, limiting losses. TLT popped up, generating a positive return in May. And in July, I had us positioned for the trade war to escalate, but they came out saying China would buy agricultural products. Funny, we've heard that a million times now. In August, he said, just kidding, they're not buying any agricultural products. So we're going to go ahead with new tariffs in October and December. And so then we get a new phase 1 deal in October. And here we are in December. Will he admit that China's never going to do anything for the trade deal and escalate? That is what I expect will happen. To close out your trade from Friday, you buy to close the 316 call and sell to close the 314.50 put. To roll over into today's trade, covering us through Wednesday, we will sell to open the 316 call and buy to open the 314 put. The debit on this trade was 29 cents, but I believe the SPY is down a little bit more. So you'll have a slightly different risk to reward ratio. Let's see where it's at right now. So currently the debit's 47 cents. I still like this trade. You're going to pay a little bit more for your protection, but you have a little bit less downside risk than I did when I put it on, and a little more upside potential. So I would not change the strikes if you're just hopping into it now. And in our portfolio, we have 19 contracts or 1,900 shares and potential profit of just under 100 bucks. So that's the potential profit for this trade between now and Wednesday. Let's take a look at the news. The long view: temporarily implementing the final round of tariffs would have limited economic impact, especially if applied based on shipping date. It would deliver yet another hit to Chinese businesses and add credibility to Trump's threats without a big hit to US businesses. So I agree with that completely. If we do get this tariff increase, I think it'll be very negative on China. It'll continue to create the Forex volatility, which is at a nearly all-time low right now. I think it's on the verge of a spike, and this would be very, very beneficial to our bond position. So we'll probably do an inverted option collar on the SPY for a couple weeks and then be ready to flip that back up and add a lot of risk. The big picture is we're in a bubble until that LQD tanks, and probably we'll have a heads up from HYG. Stock market could go considerably higher, especially after we get this big uncertainty out of the way. China hopes that it can reach a trade agreement with the US that satisfies both sides as soon as possible. China's Assistant Commerce Minister Ren Hogben said on a press briefing on Monday. China-US trade down 11% from January through November, but China recorded a 2.4% increase of overall trade in the same period. But keep in mind, they did devalue their currency by something like 12%. So that did not offset the currency value loss. Beijing orders state offices to replace foreign PCs and software. And then just a joke from Zero Hedge, but Beijing is still using Bloomberg terminals. And I do see Brent Jorgensen is in the webinar. Welcome. If you got a microphone, feel free to unmute it. We'd love to hear from you. China retaliates for Huawei. Beijing orders all government offices and public companies to replace foreign PCs and software. So here is the global central banks cutting at the fastest rate since 2009. Central banks are not stupid. They almost never cut rates unless there's very severe economic problems ahead. What they usually don't do is QE until you have stock prices crash. And the basic strategy is you get your banks to load up on all the bonds during the chaos. And as the Fed drops rates to zero, that makes the bonds go up tremendously. And then in the middle of the panic, the Fed can get away with buying the bonds from the banks for a huge profit. Stocks are cheap, and now the banks can go turn around and buy stocks. So it's a great deal for banks, terrible deal for everyone else. This time around, they can't cut rates 5%, 7% like they did in the last two crises. They can only cut 2.5% from where we got to in 2018. So they are frightened of the risk of a recession. And now we've seen 75 basis point cut. They're artificially trying to fix the yield curve and buying QE. They're doing QE while we're at all-time highs. So when a real crash does happen, the only thing they really have now is super QE, which is why we want to be long gold and be patient. Global Times opinion: how will China withstand the impact of US tariffs and the trade war? A look at the Chinese economy may offer some clues from Global Times. And so they've got their little lady at the new airport. You know what I've noticed about that gigantic, I think it was a $22 billion airport they built literally right down the road from their other airport, which is not at full capacity. It's always empty. So they're building stuff they just don't need. Japan did the same thing to keep their economy growing until real estate prices just got so high. And that's the same story. It just repeats itself. You get something good going for your country, and then this creates a surplus for your currency. The government takes advantage of that, starts issuing debt, spreading the wealth. Real estate prices get expensive, and then the corporations get the hell out of Dodge because taxes are going up, labor's going up, real estate's going up. And so you leave behind an economy in trouble. And that's exactly what's happening in China now. Plus, you've got the US forcing companies out at a faster pace than they would have just done all on their own. We saw China almost crash in 2015, all on their own, without any sort of pressure from the US. Hundreds of thousands of protesters marched through Hong Kong to mark Human Rights Day in the biggest rally in about 6 months. The rally in March from Victoria Park to Central was the first civil human rights front event in 4 months. And this was actually approved by Hong Kong. And so, as we'll see in our module 3 tomorrow, in the last 2 decades, Hong Kong's real estate, the most expensive in the world, has gone up 300%. Who can guess how much labor and wages have gone up over the same period? Any guesses out there? I'll give you a hint. It's much less than 300%.
15.
More than 15. We probably have all the buildings on fire if it was 15. But yeah, 56% increase overall in labor costs versus 300% increase. Some of the square footage in Hong Kong is going for $22,000 a square foot. Absolutely crazy. And this is the big problem all over the world. From the policies of central banks, you inflate real estate, and that just makes everything more expensive. North Korea carried out what it called a very important test at its satellite launching station, a development that KCNA said would soon play an important role in changing the DPRK's strategic status. Once again, North Korea is getting pissed about all these sanctions and is losing its patience with the US-China trade deal, which is obviously tied to North Korea. This is from Bloomberg. President Trump isn't ready to sign a trade deal with China. White House economic advisor Larry Kudlow said Friday the two sides are haggling over the amount of US farm products Beijing is willing to purchase. So I think China's just trying to play games as long as they possibly can and have no intentions to ever do anything in terms of changing the way they operate. So I do think if Trump rolled back all tariffs and just dropped the trade war altogether, they might buy some agricultural products. But outside of that, most likely they won't. They want to look strong, keep the Communist Party #1, expand their territory #2, keep the job market going #3, and then anything else after that, I think lines up. U.S. tariffs are hurting China at a time when global demand is already weak. Total exports in November dropped 1.1% from a year ago, and we're down 23% to the U.S. That was the worst result for exports. Now, that's just a general theme for China that really the growth started to collapse in 2005. 2010, their GDP had a huge crash alongside with U.S. from our housing bubble. And then ever since then, their growth has just come to a complete grinding halt. Imports are slowing down, exports are slowing down, and their reserves, they had $4 trillion in reserves. That's down 25%. Hong Kong's reserves are running out quickly. China's short about $27 trillion from where they value their currency. So it's leveraged up 10 to 1. Hong Kong is short $1 trillion based on how much money they've printed and claimed it's worth. And so they're short $1 trillion or about 3 to 1 leverage. So a whole bunch of leverage in these currencies, and a lot of money in China wants to get out. So the chaos in Hong Kong is not coming to an end. In fact, it looks like it's on the brink of really going full throttle. News ricketing through China's social media today. Library in Gansu announces burning of illegal religious and deviant materials in order to fully exert library's central role in broadcasting ideology through mainstream society. Things are changing very fast. They're burning some Bibles. Look at some Hong Kong property prices, the most expensive property in the world. Outflows from China. So the Chinese super rich, right before you see their currency devalue, you can see that a bunch of CNY will get out of China. And so we're seeing them purchase, one of the few places they can convert their currency is to the Hong Kong dollar. And then they're turning around and buying diamonds. So I guess in last few quarters, some of the biggest imports from Hong Kong to China were diamonds of all things. So they just want anything except their own currency. And the billions of dollars have been invested in China are never coming out. It's just funny money. This is more of a joke from General Robert Spalding, who was fired from military. And I believe it was from trying to critique China so much. He's very prolific with his interviews. He's got his book out, a lot of great content. The first one to really wake me up that, hey, these guys don't want a trade deal. This just doesn't work. These two policies of these countries are complete polar opposites. Chinese companies have 3 sets of books, one for internal use, one for the tax bureau, and one for US IPOs. So again, we can't audit Chinese companies, yet we're flowing hundreds of billions of dollars to their companies through our pension plans and index products. Donald Trump, why is the World Bank loaning money to China? Can this be possible? China has plenty of money, and if they don't, they create it. Stop. Kyle Bass, this just happened. Cut China off from the World Bank immediately. It's insane. They are borrowing dollars at US taxpayers' expense. Hong Kongers are being classified next to the ethnic Uyghurs, China's racist culture, Han Chinese at the top, and disdain for the rest. The US, UK, Australia, and Canada should grant asylum to Hong Kong protesters. Okay, now we're moving into US business news. The latest 28-day repo was 2 times oversubscribed with 43 billion in bids, and I believe they submitted 25 billion. BIS saying there are numerous long-term capital management type situations among hedge funds using repos to magnify leverage on micro arbitration on treasuries, trades, all enabled by dealer repos. explains why the Fed has to flood the market with liquidity. Also explains how we're able to see SPY on super low volume continue to gap higher and higher and higher from this liquidity. Here's the problem according to BIS: hedge fund leverage to the tune of 5 times in the case of Millennium and 7.5 times for Citadel is only possible as long as repo is functioning smoothly. Next repo crisis could cause a massive hedge fund liquidation cascade. This is funny, but does show you the kind of time we're in. When you see huge wastes of money on things like art, it is something to pay attention to. There's a banana being duct taped to a wall. I think they sold 3 of these for 150 grand. And someone came in and ate the banana this weekend. And then someone came in and replaced it with Epstein didn't kill himself, and security tried to cover up the message. So it was a little comical from the weekend. Here's a look at the growth of the repo market. And also when we saw the treasuries start to pull back. So I think perhaps this is all tied together. And we can see that we're now traveling to $320 billion of assistance from the Fed to the banking system. Currently every day that's being lent out. Here's those 3 huge hedge funds that are loading up on leverage. So normally Millennium's a $37 billion fund. They're doing a very similar strategy. All of these guys are doing very similar strategy to what we're doing, but they're using massive leverage and really tightening those strategies to prevent loss. And Millennium, for example, is only trying to get more like 8% a year. So it's interesting that they use so much leverage to pull that off. Now, this is just showing the correlation to the Fed's balance sheet and the futures market on the S&P E-mini. And so as the balance sheet goes up, prices on SPY are going higher. So again, although I am suspecting a sell-off in stocks, I think it'll be short-lived and we travel dramatically higher. The big picture is if we create chaos in China, that creates chaos in just about every other country around the globe. It causes their currencies to devalue, which causes a general theme of money flowing into the United States. So we get that, plus we get QE4, and we're going to have a bubble like none other. Here's the chart that shows you how sharp the expansion of QE is. This is the fastest growth of the balance sheet in all time history. And they're saying it's not QE. Now, recession Google Trends searches died down after spiking recently. So it's interesting to see people like to search recession after a crisis, not before, if you go back to 2008. The era of central bank shock and awe is over. After more than 10 years of crisis fighting, more than 750 interest rate cuts since 2008, policymakers are facing a new decade with rates around historic lows or negative and few good options to fight the next downturn. Bank of America analysts are among those warning investors to be alert to quantitative failure or monetary policy impotence. So the big idea is that this whole strategy of the central banks being able to just essentially print money to try to redistribute wealth and kind of grease the gears to keep economies going is coming to an end as all the central banks are near 0% rates. So all they can do now is print till inflation comes in, till credit markets crack, and then we get the big reset. Consumer spending is back to borrowing, and so we talk about all these great numbers with US growth and all this and that. But the bottom line is we're growing debt faster than we're growing GDP. So this is not something that can last forever. And unfortunately, we're definitely coming towards the end of the rope because we're getting near 0 on the federal funds rate. After that, again, they're going to scare the bond market because they won't believe they can buy and hold for a profit, which is, that's the effect we've had with central banks, is they are distorting the financial markets. Now here's your JP Morgan Global Forex Volatility. The big devaluation in currencies really began a decade ago, which you can see this spike. And ever since then, as we'll see in our module 3 lesson tomorrow for boot campers, there's just about no currency that has been able to stand its ground against the dollar over the past decade. There's a few pegs that are still alive, Hong Kong being one of which, but Hong Kong's economy is tied to China, so their currency should be tied to China. And China's going through a massive slowdown and restructuring of bad investments. United States is not doing that. So United States central bank policy is much different than China's. China's facing 3 to 4% inflation. They really should be hiking rates while the United States is cutting rates. So this mismatch is what's causing a lot of pressure on Hong Kong and why we want to be short the Hong Kong dollar if these pressures continue to grow. It's really a bet that they'll run out of dollars in the next year or two. My expectation is this chart spikes very soon from the trade war escalating, which will cause China to devalue their currency, which causes all their trading partners to devalue their currency, which again turns into this setup where money is just going to flood out of local governments and buy up US assets. And what's funny is if Trump actually did a trade deal with China, it might actually reverse this whole theme where all of a sudden the rest of the world looks attractive at 14 PE ratios versus US's 18. So we may not actually want a trade deal if we want money to continue flooding into the US. Okay, now we're looking at some politics. Listen to a 30-minute interview with Joe Biden and CNBC host. And gosh, some of the things they say about his son being completely, all the drama about his son taking money being a complete hoax, just completely, obviously lying about it. And it's in a scene at a bar. So just bizarre. The poor guy can't really form a full sentence for more than 30 minutes at a time. So I just don't see who on earth is going to inspire people in the Democratic Party going into the 2020 election. We have the impeachment heading full steam today. Adam Schiff is not going to testify, sitting in his staff. Republicans are pissed. Here's a recent MAGA. You can see the sold out crowd. Makes me wonder if he was impeached, would we have some sort of civil war with the United States? Very interesting times. This is all very repetitive, so I'll kind of skip through it. We got Trump talking about Hunter Biden and Ukraine. We got Trump saying Kim Jong-un is too smart to start blowing off some nuclear weapons and ruin the potential for a deal with the US. So we'll see. As far as timing goes with the impeachment, we're now expecting the potential for them to draft the articles by the 20th. And so this could hit the Senate by January. And this still boggles me that they would want to dig up so much dirt on their own party. If this does go to the Senate, there's going to be a lot of dirt dug up and put into mainstream media that goes beyond what the Democrats are pretty much just focused on, which is that Ukraine call and holding aid. Leading constitutional scholars were clear. President Trump abused his power, will continue trying to corrupt our democracy, and committed impeachable offenses. Now, Rudy Giuliani had some interesting tweets. I believe these came out Friday. In reviewing my notes, it seems to, now he's known for busting up some pretty big mobs in New York. Apparently, I'm not too familiar with his history. But here's his tweets. In reviewing my notes, it seems to me that a large-scale joint investigation into Ukraine and the U.S. would uncover and recover billions stolen by crooks from both countries at the highest level. This would be the most effective way to bring our two countries together. Shocking disclosure, much of the $5.3 billion in US aid Ukraine reported as misused was given to the embassy's favorite NGOs. At the time, Yovanovitch, witness for the witch hunt, was at the ambassador of the embassy, directed the police not to investigate. She also blocked their criminal justice department from flying to the US to report this to the Department of Justice. As it comes to a huge shock to Democrats, the real Donald Trump will ask for investigations concerning violations of US law and misused hard-earned taxpayer dollars. It's called his legal obligation under Article 2, Section 3 of the US Constitution. Michael Bloomberg says, I have the same rights as anybody else to run in the 2020 election. And so far, he's not off to a hot start. People have said he's been fat shaming and making fun of people's IQs, talking about creating taxes to help direct their behavior. General Robert Spalding had a funny tweet related to this. From now on, let's say everyone has to crowdfund their campaign. Contributors must have verified U.S. identity, and donations are capped at $2,000. Call it the U.S. Elections Declaration of Independence from corporate and foreign political influence. Not a terrible idea, but then you probably have Bernie Sanders taking advantage of that one. Epstein was a Mossad agent used to blackmail American politicians, former Israeli spy claims. I haven't read that article, but he did seem to have a lot of ties to Victoria's Secret owner, who apparently was tied to Assad. Okay, so that's a wrap of our top news. We've reviewed our trade alert. Let's go ahead and open up for questions now. Jim, I see you got your hand raised. You got a question? Oh, VIX is up a bit right now. Let's see. Yeah, SPY's still hanging in there. Fireworks aren't out yet. Go ahead, Jim.
Yeah, sorry about that. I raised my hand by mistake there. I was carrying my phone along my pocket there and it triggered, I guess.
Oh, no worries, but now you got to ask the questions, so go ahead. No, just kidding. Dawn, Ernest, anybody, any questions out there?
No, I do not have any questions.
All right, guys. Well, our patience is going to pay off here. We've been holding on to that TLT and letting it slow bleed for 3 months. So I think the patience will pay off in the very near future. Oscar, any questions?
Jason, my only concern on the TLT is this, you know, the artificial repo buys. Is the Fed coiling the TLT to really kind of crash?
The Fed is currently buying the front end of the Treasury. Oh yeah, that's one thing I did want to look at. So we really have to look at your Treasury curve. I've got a really cool video that shows the yield curve over the last, I think it's 50 years, so you can see how it plays around. I'm trying to zoom in on this one. Hold on.
Jason, you want to mute everyone real quick? We're getting a little feedback.
Sure. Okay, I'm going to leave. That was your question, right, Oscar? So here's a look at the yield curve every quarter for the past few quarters. And so they are, let me just delete some of these so we can see how it looks right now. So right now we've got a pretty clean yield curve, and it's the basic idea is the longer you're going to borrow, the more money you should get paid. But you can see if you watch this yield curve over history, it sure as hell doesn't do that. It wiggles around, goes flat, goes inverted, steepens. And so the big fear for the stock market would be a steepening treasury curve, which could potentially pull that 30, 20-year treasury way above 3%. And that's when we'd really get scared about a bear market in stocks. Now, let me add, let's go back to before they started repo and see how it looked. So I think September is when they had the emergency. Let's just look in August. So now that is what we call an inverted option yield curve. So you're getting paid more money to borrow at the short end of the treasury, and you're getting paid less to obviously take more risk and borrow for longer. So that's what freaked out everyone. And they said, oh, it's not a big deal. And then they threw an emergency meeting and started to artificially try to steepen the yield curve and straighten it out. And so you can see they did that. So they have put a ton of money on that short end of the treasury to push that down. And they've allowed the long end, which is our end, to rise up. Now, they don't have good products necessarily let me pull that up. The TLT is our best product on the ETF land. And because it's the longest duration you can get your hands on, it provides the most reaction to rate changes. But you can see right here, we have two other products we could look at in the future, which are the opposite. So expecting rates to go up. So we have TYO, which gives us access to that 7 to 10 year treasury. And we have TTT as a negative, like the opposite of the TLT. And so in general, right now, at this point in time, the Fed is only manipulating the front end. And you can see they've dragged that rate way lower. So my expectation is any fear in the market whatsoever that we're going to have growth problems into next year. We'll see most of the move come in at the long end of the curve, which is good for us. So they're currently putting a ton of money on that 1 month, 3 month, 1 year treasuries, and they're not touching at all the long end. The bad news is that's allowed us to have to feel the pain of this. You can see from going from 1.7 on the 20 to 2.14. That's really what we've just witnessed over the last few months. And then on the 30-year, going from 1.96 up to 2.29. But if we do get a panic, where are you going to bet that the rates will go down? Probably not on the front end. The Fed's already pretty much keeping that at 1.5. It's already dropped it way lower from above 2. So the money to be made betting that rates go down is now completely really sitting on that 10-year, 20-year, and 30-year treasury. And really, you can see these ones maybe go down a little bit, but I think your 20 and 30-year have much more room to go down. So while it has been painful over the past 3 months, good news is we have massive potential profit on the TLT if growth expectations become hampered because of, it doesn't even necessarily have to be growth expectations are low next year, but we're going to get this flood of money from around the world. Where are you going to bet the rates go lower in terms of buying your bond? There's not a lot of room on the front end of the curve. Really, all the money to be made is right here. Let me try to zoom in on this, see if it doesn't. So we'll start looking at the yield curve every day too, as that's really there's a lot of interest rates, but you can see how they have manipulated that and straightened it out. And so if rates go too expensive, that's very alarming for stocks because just like you saw in those examples where these guys are using 5 times leverage, well, they would love to pick up a 30-year treasury with 3.5% yield for, that's a guaranteed profit for a huge amount of time when it gets to that point. Right now, people buying the 20, 30 year are not going to be buying it for the yield. They're going to be buying it expecting those dots to drop down considerably. And so if we have the federal funds rate headed towards zero over the next 12 to 24 months, plus we have US-China trade talks breaking down, this yield could certainly go much, much lower. Does that make sense?
Yes, sir. I'm afraid to say so.
Okay, good. So yeah, so it's kind of nice. You know, if we had a product where we could have played the short end of the treasury on the ETFs, we could have made a fortune on the bonds just over those last 3 months while the rest of the curve went up. And so, you know, that's a whole specialty in playing those all the different durations on the treasury. But you can see the front end has collapsed way lower, and the long end, which is what we have exposure to, has lagged. In fact, it's gone up. So I do suspect those will come back down more in line with the front end of the curve the second we have any kind of scare, which could be this week. So there's a big potential, you know, just to get back to where we were in September is a big move. I mean, I think that was what, 148 is where we tapped out at. Pull that up. Yeah, 147, 148.81. Wow. So just to get back to where we were in August, which that was when they first did the trade. You know, look, that's exactly what happened in July. Trade deal was great. We had a little sell-off from the TLT. Osaka meeting. China's buying some agricultural products. Hurrah. And then what happened? Oh, no, they're not buying shit. We're going to raise the tariffs, and bond market flew. So just to get back to the fear level we had in August would push us to 1.96 and 1.78. So we have a potential $10 run up on the TLT just to get to where we left off. And then you add on to that, we're going to expedite the federal funds rate getting cut towards zero. Trying to predict, you guys have heard me as far as how low I think this could really go, and in terms of how high that could push the TLT. I'll do some more detailed calculations and try to get a better aim on it. I'm going to be getting scared of the TLT somewhere between 165 and 180. But if we don't travel the TLT to that level in the next 24 months, there's a few things that can happen. Let's assume that the United States cannot create GDP growth greater than it's creating debt growth. Okay, and there's a whole, you know, we could do a whole 2-hour presentation as to why that would be extremely difficult. But assuming, you know, we could keep our GDP between 2 to 3, but we continue these massive deficits. So our deficit's greater than our growth. Well, that's what really forces the Federal Reserve to just slowly but surely baby step the rates to zero. And so if that doesn't happen, yields spike, stocks crash, credit markets done, corporate credits out, layoffs. I mean, it would be a complete nightmare. So that's why the Fed doesn't spend any time talking about inflation. They say, hey, we need to let inflation run hot to make up for all the inflation below 2% we've had over the last decade. That's what they say. So there's no chance of hiking rates. It would destroy China, but it would also cause a massive recession in the United States. So they know they can't do that. If they don't keep these rates going lower, they're going to have to not fund the government. So it's just that simple. But the problem, what the Fed does talk about in their latest, in all of their FOMC minutes, is what do we do when we get to zero? And so the big ideas they have is, number one, we're going to cap yields. That's what Japan has done for since 1990. So they've just bought every bond they issue and don't allow it to have a high yield. And that came at the cost of their real estate market tanking and their stock market tanking for a better part of 30 years now. So yeah, that's one idea they have, is let's Japanify America. Hopefully they don't do that. Second idea they have is, now Powell says this is off the table, but other Fed speakers do not. It's in their own FOMC minutes. So I don't know why so many of these analysts say there's no chance of this, because it's clearly at least a page of this, at a minimum, an entire page dedicated to the talk of negative interest rates, which could potentially get us way above the 180 level on the TLT. And then the third thing they're talking about is unlimited repo. So, yeah, we've got quite a run on the TLT before the game's up for the Fed. And good old Treasury yield curve right there. So right now, just to get back to the August level, we got a $10 run up.
Hey, Jason, just real quick, for William Noland, Brent Jorgensen, Don Smith, and Jim Locke, will you just kind of go over why we're structured the way we are with the portfolio? And, kind of just tie in why bonds are important to have at all times.
Sure. Yeah, let me pull up a little bit of. Now on Wednesday, Thursday, Friday, guys, I'll be giving a longer presentation because we don't have our boot camp content. But we'll do a quick little overview here of the relationship on the stocks and the bonds. And we'll probably wrap today up, so I have a little break before our Q&A boot camp. Okay, the easy way to predict markets and generate safe income, daily income trade alerts at noon Eastern. This is our trading plan. We trade the SPY ETF Monday, Wednesday, Friday, emerging markets on Tuesday, the bond and gold market on Thursday. Ratio is pretty easy to remember: 100 shares of the SPY, 200 shares of the other assets. All four assets are uncorrelated, which gives us a very smooth return. Our goal is to generate 1% a month, and we've had an average return of 1.25. Profits in 11 of the past 12 months. Largest drawdown is negative 1%. And we've never lost capital over a 90-day period. We looked at this earlier. Our simple 4 ETF portfolio is extremely diversified in all you'll need for your retirement. The goal is to generate income and safety, not growth or speculation. This allows you to simplify your holdings, reduce your risk, get better results with less work, and weatherproof your retirement portfolio. We really have 3 setups that are managed with the options market. So we always own the same assets. That does not change. What does change is how we manipulate the trade with the option collar. If you see the plus sign, that means we're long that asset. The sideways sign means it's still bullish, but it's going to be a very tight option collar, so we have very little downside risk. This is our position if the trade war is up in the air. We don't know what's going to happen. We have low interest rates that are headed towards zero. We have low inflation, putting no pressure on rate hikes, and we have quantitative easing. That's the perfect recipe for a stock, bond, gold, everything bubble. Now, if we have an escalating trade war, but we still have low interest rates and low inflation and quantitative easing, for a short amount of time, we'll be willing to be negative on the SPY and emerging markets and be extra bullish on the TLT and GDX. This is what I believe is headed our way in December. So if you've collected some big profits on equities this year, maybe it's time to protect those with some options. And you can see how to do that in not this slide, but the next. The other setup, which we've seen in July and also in October, is the effects of a de-escalating trade war. This is where you get a short-term sell-off in bonds and gold. We know for sure bonds have to travel higher in the long run, but a de-escalation does create a short-term sell-off. So we're long stocks, short bonds when the trade war de-escalates. Now, my probabilities for what happens this week: number 1, tariffs go up by Friday evening after the market closes. Number 2, probability, and remember, tariffs are due Sunday, so that's the deadline currently. If the trade war is to push the tariff deadline to January, we'd be back to up in the air. And if the trade war were to actually sign a phase one trade deal this week, I'd be shocked. But once again, we'd want to be long stocks, short bonds. This is how we protect our positions. We have the bullish loose option caller. So we sell an out of the money call and buy an out of the money put. This allows us to have the biggest risk to reward ratio and what we want to do if we think the asset will travel higher. Current trade is a tight option caller. So we've sold an near the money put, or rather near the money call, and bought a near the money put. This dramatically reduces our risk to reward, so we can make less and lose less. And then we have our bearish inverted option caller. So this allows us to own the asset, sell an in the money call option, and buy an in the money put to profit from a big downside move safely. So we're actually able to buy a very valuable put that offsets any drawdown in the underlying asset by selling an in the money call option. So we're leveraging our asset at all times to sell call options and using that to finance our trading goal. Now, the big thing we're focusing on is the Fed. What's the Fed doing and what are they thinking? Right now, they're buying bonds and they're lowering interest rates. So this is bullish for stocks and bonds. And the only thing that'll stop them is inflation, which comes ripping every so often throughout history and causes massive losses to investors. What you want to look at in this chart, up top, we have the SPY. Down below in orange, we have the TLT. Only thing to really focus on is both have traveled higher together over time. But whenever the SPY tanks, the orange line pops up. That's our relationship between the stock and bond market. That really smoothens out our returns and makes this strategy so safe. Also, here's a look at the TLT. You can notice it kind of is a boring ETF until it spikes suddenly much higher. Those line up perfectly when stocks sell off. So when you push these two together, your portfolio is much more weatherproof. Here's a few zoomed in looks of the SPY versus the TLT. All I want you to notice is when one goes down, the other goes up. In general, they're both going up together. That's because the Fed has been able to cut rates for the better part of 40 years from 20%. A shout out to Paul Volcker. I guess he passed away either yesterday or today. He's the fellow who had the guts to crank up interest rates all the way to 20% from 1965 through 1980 and got all the malinvestment out of the economy and set us up for this massive bull market we've all enjoyed over the last 40 years. Even when stocks go sky high, bonds still don't kill your portfolio. You can see in 2013 through 2015, bonds ended the period down 2% while your stock portfolio went up 51%. So it allowed you to have the downside protection without hurting your returns. Here's another look at the most recent history. And you can see once again, in this case, the SPY traveled up 33%. And every time it had a little bit of a pullback, we saw the TLT spike to remove any volatility. Now into current, both stocks and bonds are up tremendously this year. This has been the year anybody could have thrown a dart at any financial asset and made money. These sorts of environments don't last long, so I don't suspect 2020 will be so easy to make money. In fact, I think we've hit the all-time high for the SPY, potentially for a long period of time until this trade deal comes to a conclusion. Buy gold when the Fed is buying treasuries and cutting rates, short when they're tightening policy. Right now they are cutting rates and buying bonds. Last ingredient we need for gold is some fear, which I do suspect is headed our way. And so also we can see that gold and TLT are somewhat correlated, but they do break paths. So it does add another layer of uncorrelated risk to our portfolio. Now that gold is at 1,500 almost an ounce, makes more sense to own the miners who can generate a large profit. So we like GDX over GLD at this point in time. SPY is $262 billion in assets under management and averages $20 billion a day in trading volume. It's overweight in technology and finance. These are your biggest companies you own when you own the SPY. Now, let's take a quick break. Brent, are you out there? Do you have any questions? But that's a good overview of the strategy. And so I'll go ahead and close out today's webinar. If you are watching on live stream on YouTube or the recording after the market closes, I want to shout out that you can call Dean now to lock in your discount and get a free month in our $10,000 bootcamp program when you upgrade your free trial. Call Dean right now at 505-322-7515. We'll have a longer presentation on Wednesday through Friday. So if you want to watch a little bit more of our bootcamp content, make sure to join in tomorrow, Wednesday, Thursday, Friday. This is a daily live webinar. And I want to say thank you to everybody who joined us live today. Any last questions before we wrap up today's presentation?
Yep. Brent, Don, William, please feel free to jump in if you have any questions, guys. We'd love to help you.
All right, gentlemen. Well, another great webinar. I appreciate your time. We'll have our next webinar tomorrow at the same time. So thank you so much.
Thank you, Jason.
Thank you, Dean.